So I always say this. Maybe it sounds corny to those of you that have heard it before, but there's actually a lot of truth in it, and it's why I say it all the time. But there are two ways to get rich and stay rich. There's only two. You can either make more than you spend or spend less than you make. That's it. Now, if you want to get rich and stay rich, you have to follow those two principles. And it sounds like it's kind of the same thing, but it's actually not. One of them focuses on making more money than you can spend. That's almost an impossible task. Uh, all of us have a tendency to always want more stuff, right? And have nicer things and go on more trips and all of those types of fun things. The human appetite is almost insatiable as far as how much you can spend. But getting that income component to be larger and larger, especially that passive income component, makes it so that you have the ability to live the lifestyle that you want. Okay. For the most part, you still have to have at least a little bit of constraint, right, on some of your appetites. One of the first things that I learned early on was from Robert Kiyosaki, where if you can create an income stream that is independent, it's passive. In other words, you don't have to actually be doing it. If you can create a passive income stream that is greater than your expenses each month, then you've kind of left the rat race. You're free to now do what you want to do because it's what you want to do. And when I first retired, I did that when I was about 32 years old. Did that for a few years. It's kind of a long story how I got there, but basically, we had created a business that wasn't in this business, by the way, but we had created a business that had an income stream, and then we had some investments and things like that that we had done right, where we had an income stream that was able to produce more than what we needed. And on the other side of that equation, it's the income and then your expenses. On the expense side, my wife and I have always been pretty frugal, and so we just don't get into super expensive, fancy cars and houses and all that kind of stuff. So it's just not what we're interested in. And so creating that passive income to then let you escape, if you will, that escape velocity of the bills and being able to just be free to go do what you want. And then there's, of course, all kinds of curveballs that life likes to throw you and everyone else that you don't really know exactly what's coming. And so you really want to build a big enough buffer in both your assets as well as your income stream to be able to withstand, some of the curveballs that life throws you with health challenges and who knows what, right? We just don't know. So one of the first things that I want to, or I guess what I want to focus on today is how to pay off a mortgage with a lot less money than actually paying it off. You had some rich uncle that came around and just, paid for your mortgage and you just didn't have to worry about paying a mortgage anymore, your taxes on your real estate or anything like that. What would that be like? What would that do to your lifestyle? What would that do to your stress level? But we're going to use a mortgage example that's 300,000. In fact, with mortgage expenses and closing costs, we're going to say that we're starting out with a mortgage that's $308,000. And that's the example we're going to use. Obviously, if the mortgage is bigger or smaller, it's the same thing. It's just scalable up or down. Now, you have a couple different things that you can do with paying off a house. If you have a lump sum of cash, you can just pay cash for the house and there you go. But then you've got a lost opportunity cost. What is that lost opportunity cost, and is that a good idea or not? And we're going to talk a little bit about risk and some things along those lines as well. But most people don't have the money to just go pay cash for their house, at least not when they're getting started. And so we're going to go through some other scenarios where we're talking about putting some money aside to get a mortgage paid for. Now, there's a couple different ways that a lot of people go about paying off a mortgage early. Some of them, they just set up a higher payment. So instead of a 30-year mortgage, it's a 15-year mortgage. And then they just pay that extra amount each month, that bigger payment. Sometimes usually saves them a little bit of interest as well, on the interest rate on the mortgage. And then they just, put the nose to the grindstone and it gets paid off faster. Some people have tricks for, paying every 2 weeks, where you get an extra payment or two every year to the mortgage, and that helps pay things down a lot faster. There are strategies for using a line of credit. In fact, there's one company, I call it the Magic Mortgage. There's really nothing magical about it other than it's set up kind of like a line of credit, or in some cases it is a line of credit where you basically funnel your entire paycheck into this line of credit. You pay it down, and then as you need to pay bills, you just pay bills out of that line of credit. So it's almost like a reverse checking account, if you will. Instead of putting money in and then pulling it out, you're paying down the line of credit and then increasing it as you pay bills. Does that make sense? Well, you wouldn't think that such a small thing would have much of an effect, but it actually has a very large effect in how interest gets credited and saving the interest. While your money is in there, while that paycheck is in there, it's saving you some interest. And you're not having to pay interest until you then draw against it. And so anyway, it's a mathematical trick. It's a little bit of a psychological trick. But that same cash flow helps you to pay down the interest a little bit sooner. And so those are all tricks that we're not really going to get into much. I just wanted to recognize them as little tools of the trade, so to speak. There's all kinds of things out there that you can use for some of those tricks. We're going to show you something I think much more powerful, far more powerful, and that's how to get your mortgage paid off with actually coming up with a lot less money. In all of those examples I just showed you, by the way, you can do multiple things at the same time, by the way. One is not exclusive of the other. But in those examples I just talked to you about, we're actually paying off the full $308,000 mortgage that we're taking out today in every single one of those. There's just different tricks for how to get that paid off sooner, right? And some of it's just cash flow management techniques, things like that, or coming up with extra money. What we're going to talk about today is not actually paying off the mortgage. It's getting the machine built so that you have an income stream that will eventually pay off the mortgage and give you a whole lot more. But kind of like what I talked about earlier, it's all about not necessarily paying off the mortgage. It's about creating a machine that creates the income that will pay the mortgage. And instead of paying $308,000 to get that mortgage paid off, what we can do is pay a lot less into something that will create that machine. Okay, does that make sense? I don't care how aggressive you are or how conservative you are, a portion of your assets should be in something that is liquid and conservative. Like, you cannot have all of your money tied up in real estate. I don't care how much you make in real estate. If you have 100% of your money tied up in real estate, you will go broke eventually. You're going to have some hiccups in your cash flow. Something's going to break on a house or something, and you're going to have to repair it. You're going to have some renters, not pay you. There's always something that requires an emergency fund. It requires some liquid available cash. Okay. And so I love real estate. You just can't have all of it in that. You can't have all of your money in something that's high growth and illiquid. It's just not wise. And so when we look at the world of conservative investments, I always encourage people to look at life insurance, even without the flex method. So even without all of the other things that help enhance the returns that I would expect to see in life insurance, or in conjunction with life insurance, I should say, if we just look at the world of conservative investments, it's one of the best places to park your money, as long as you have the time horizon it takes to get that policy up and off the ground, so to speak. It has all of these other characteristics that you can see on the screen that we love about life insurance. If it's a whole life policy, you're probably, if it's built correctly and funded correctly, you're probably going to be in the 4 to 5% range after taxes on average. If it's an IUL policy and it's with the right carrier and funded correctly, built correctly, it should be in that 5 to 8% range. That's without all of the other bells and whistles of the the flex method. Okay. So with that, the reason why I mention that is when we want to pay off a mortgage, you still need to have an emergency fund. If you are making double payments, there's a risk to that. When you pay extra payments, or let's say you get a tax refund, you got a chunk of money. If you take that chunk of money and pay down your mortgage, it doesn't change the mortgage payment that you owe to the mortgage company. So if you get let's say you drop in $30,000 extra to pay down that mortgage, and then the next month you get disabled for some reason. You're temporarily disabled and you can't work for several months. Well, what happens to your mortgage? You cannot call up your mortgage company and say, "Hey, I paid you extra. Can you just stop sending me bills for a few months until I get back on my feet?" They're gonna start foreclosure proceedings. That's all they're gonna do, right? And so paying down extra is great because it helps save you some interest, and it's saving you interest at whatever the interest rate is on your mortgage, but it's not available to you. And if you have a line of credit, then that could be available to you, should be available to you, unless for some reason they closed the line of credit, like for instance they did in 2008 and 2009. They just closed the lines of credit. The banks were scared, needed to make their balance sheets a little bit better, and closed up a lot of lines of credit, even if you weren't disabled and were still working. And so having that equity tied up in the property does have a risk to it in case you need to access it and aren't able to for whatever reason. So I just wanted to bring that out as a point of risk, if you will. Now let's get into the fun part. Okay, the first example we're going to show, I've shown before, and I just want to bring it up. Not that it's a very common example, because most people don't have cash to drop in. So this example is someone that has $300,000 to pay for the house, but is looking at instead doing the flex method and then getting a mortgage for that $300,000. So maybe they've got, let's say they've got, I don't know, $350 or something. They put $50,000 down on the house. The other $300,000 they can either pay cash for it and not have a mortgage, or get a mortgage for $300,000. In this case, with closing costs, we're going to say that $300,000 is going to cost them $308 because of those closing costs. And what we're going to do is we're going to take the 300, we're going to build a flex methods plan for them. And I'm just going to focus on the results, right? It's not the policy and the tax savings and all the other pieces of the puzzle that come into play with the flex method. We're just going to show the aggregate results, and that's here. If we take the 300,000, drop it into that flex method plan in this example, and this is a 45-year-old, we're going to then pull out the income that's needed to pay the mortgage. So it's going to take $23,235 per year to pay that mortgage. And so we're going to take that starting in year one. That's why we've got 300 going in, 23,235 coming back out. So we have a net input going into this plan of 276,000. And then starting the very next year, we're going to pull what's needed for that mortgage, so that the person, whether they pay cash for the house or whether they do the flex method and get a mortgage on top of it, there's zero cash flow. They don't have to think or worry about paying the mortgage. Okay, so cash flow is exactly the same. So in this column right here, and I know this isn't like super pretty or anything, if we assume $308,000 mortgage, the payments every month over 30 years are $1,936 a month, with a interest rate of 6.5%. I think that's about where things are right now, last time I checked, for a 30-year mortgage. So again, we take the money and take the cash and get the mortgage for the house and then use our cash to start the flex method. We take out what's needed to pay the payments every year. And then after 30 years, we have, surprise, a mortgage that's paid for. Okay. But what we also have is the cash values of our strategy is now still worth, anticipated, obviously, based on AG 49 numbers, the carrier numbers we think are extra conservative. It's still worth 976,000. And if you'll notice, starting in year 16, the income that we're taking out is not just for the to pay the mortgage. It's also a whole bunch extra. So take these numbers each year. This is the income column. Take these numbers each year, and that's that extra income you can go ahead and put in your pocket. Okay, the client can go ahead and put in their pocket. So for half the time, they're just getting enough income to pay the mortgage. The other half of the time, they're actually getting a significant amount extra. So does that make sense? So, and that income doesn't stop just because the mortgage is paid for. We've created a machine that's not only spitting out enough income to pay for the mortgage, but it's also now spitting off enough to pay a little bit extra. And when that mortgage is paid, it continues to pay us. So there's enough growth and income in here to also pay for retirement. I would think most people could live on that pretty, pretty well. And by the way, one of the most important pieces, we've got a death benefit. Something happens to you, there's enough money to not only cover any mortgage, but there's enough money to help your family replace your income and continue going. Not a very
And
common scenario. Not a very common scenario, but I would say, like, for instance, if you just pay cash for that house and let's say you get disabled, okay? One of the dangers, yes, you paid cash for your house, but one of the dangers is how do you go get a loan when you are disabled and can't work? That's tough. So there are times, and by the way, I wasn't disabled, but in 2008, 2009, we had a large custom home paid for, 40 acres that were free and clear. And we had some other assets and things, but there was no way for me to get a loan if I wanted to at that time because everything was just locked up. It just was completely locked up. So it can happen. It absolutely can happen. So I like having this available, this money that's available in case there is, something that's going on. Fundamentally, I want you to think of things. It's actually very simple. It's extremely simple. Which should I do? Would you rather pay cash and save 6.5%, or would you rather have more cash available, have the protection for your family, and be averaging something that's double digits? And maybe it's not 13, maybe it's 11, maybe it's 15. We don't know what the future is going to bring. We think this is actually fairly conservative, on the conservative end of what I would expect. So
how
does
do
that make
you,
sense? It's that simple. 13, 6. It's
the
pretty easy.
numbers don't lie.
The numbers don't lie. Okay, let's shift gears. Let's go to a scenario where we've got something a little more typical. So in this scenario, what we're going to show is let's say it's a young person getting going. They're 25 years old at the end of the first year at 26, but they're just getting going. They need that mortgage to be able to get into the house, right? They have $10,000 of an emergency fund, which I would say if you don't have an emergency fund, you have to have an emergency fund. You definitely should not be buying a house if you don't have an emergency fund, because you will have things break. It just happens, right? And life happens. And so $10,000 emergency fund, I think, is a decent start. That's the example we're going to use. In other words, most people take that 10,000, they just keep it in a bank. We're going to show taking that 10,000, and then we're going to show what it looks like if they were to pay an extra $5,000 a year. In other words, they're saving $5,000 a year, a little over $400 a month. And we're going to take that and add those two things, an income stream of 5,000 a year. We're going to do it for 13 years. And we're also going to add into this policy their emergency fund of $10,000. Okay. So we're going to get started the first year with 15,000 total. That's 5,000 from income, 10,000 from their emergency fund. Okay. If you'll notice, we've got about 300,000 of death benefit. The way I like to build these policies, this is going to be kind of a flex foundations, I like to call it. It's just that kind of that starter flex method. We can't have all of the components of it, but we still build a policy that can stand alone and by itself without any extra money going in. If something were to happen, it's still a great asset to have. And so as we continue to pay into this policy, if you'll notice, the death benefit jumps up in years 3 and in year 6. Will it happen in year 3 or year 6? I don't know. We don't know what's going to happen in the future. But on average, we can expect that, if things happen on average, that about year 3 or so, we can stack on another policy. In other words, there's enough equity inside of the first policy that we can stack on another policy to get him some more coverage for his family, and then to provide some more capacity to do the flex method. So you can see the cash values, how they're starting to grow. Same thing in year 6, we do the same thing. If it makes sense, obviously, if it's not quite ready yet for whatever reason, maybe we get that second policy in year 4 or year 5, or maybe it's not until year 10 that we do that third policy. It just depends on how the policies are performing. They may be able to put more money than we're thinking. They might get a raise 5 years from now, very typical. And they might be like, yeah, I love this. Let's do extra, We don't know exactly what's going to happen, but what we're going to show in this example is 5,000 a year plus that initial 10,000. Now, if we do the normal mortgage, by the way, this is in addition to paying the normal mortgage. So they have their normal mortgage payment that they're paying, and then this is extra. Okay? Everybody clear on that? So if we look at year 13, and year 13 is the last year we need to do this, because we're anticipating that by year 14, the beginning of the 14th year, we actually can create enough income ongoing that we can expect to have about $23,000 in income. We just created the income stream to now pay for the mortgage for the rest of that 30-year period. Does that make sense? So now, not only are we not adding an extra 5,000 a year, they can take that extra income and what they had been paying on their mortgage, the 23,000 they'd been paying previously, they can now take both of those amounts and now do something else. They can build a retirement fund, a vacation fund, or whatever else it is that they're going to do. Okay. We have liquidity. We've got more of a safety net. So we talked about that emergency fund. We now have more of a safety net in case something does happen to them. We've now got more death benefit and protection for their family. Okay. We now have some critical care riders. So if they do get terminal cancer or whatever happens to them along those lines, they now have some really cool benefits in addition to the fact that they created the machine so they can stop worrying about their mortgage at age 38. Okay, I want to show one of the questions that I had that I thought or I anticipated somebody might have is, well, yeah, but what if I just take, Dave Ramsey says I should take that extra 5,000 and pay extra on my mortgage. Okay, let's look at what that looks like. If I take the same mortgage and I pay an extra $5,000 a year down on that mortgage, this is what it looks like. Okay, the mortgage actually gets paid in let's see, 18 years. Okay, well, 19, I guess, 18 and a half. So that's cool. You just saved a whole lot of interest. So it's not a terrible strategy, but that equity, all that extra equity you created, it's not available to you if you get disabled or something. So that's a caution I would have. But let's take a look at it. After 13 years, you would owe about 137,000. Doing it this way, we've now created the income stream to pay for the mortgage. And so that would save me, what is that, 5 years worth of payments? Okay, that's $100,000 worth of payments, roughly. A little over that, actually, in 5 years. So, and we've got more available to us if we ever had an emergency or needed to do something else. So, again, think about it in really simple terms. Am I better off taking this extra $5,000 and earning an average of double-digit returns, or saving 6.5%? Because in both strategies, the money's accessible. In one strategy, it's accessible and conservative. In the other strategy, paying down the mortgage, it's considered very conservative, right? But my money's not available, so there is a risk there. But again, 13 or 6? Which one do I want, right? What if you had just a chunk of money? If you had $80,000, you could create, you'd have to pay the mortgage out of pocket if you did the mortgage. So let's say you had 80,000 that you could throw down on this mortgage. Again, are you better off to save the 6%, or in this case, we're expecting to average about 13 or so in this strategy. So which is better? Well, I take the 13. That's what I would do. I think it's actually less risky and obviously produces a lot more. So in that scenario, you would still have to pay the mortgage and pay that 23,000 a year for 9 years. Okay. So starting in the beginning of the 10th year, though, you would now have an income stream that essentially pays for the mortgage. Okay. So again, we can take a fraction of what would be needed to pay off that mortgage. We can take a fraction of that. Roughly, it's about a third, give or take, and that will create an income stream to pay for it. Okay, so with about a third of the money. And that is loosely the numbers when it comes to anything. So if you've got to, if you're preparing for retirement and you need 5,000 a month or whatever that number is, then if I need to create an investment, a big pile of money that's growing and is invested, that will create that income stream of $60,000 a year after taxes, I'm going to have to create a much bigger pile of money and investments than what it would take to create the income stream inside of the flex method. And that is one of the, even by the way, without the flex method, even just a normal insurance policy, I always say it kind of punches above its weight level when it comes to income. The same amount of money in an insurance policy just by itself without any of the other flex method components, it typically creates an income stream that you can see in your illustration software, that to create the same tax-free income stream, you'd have to have a much larger amount of money than what you've put into that policy. So sometimes people get really zeroed in and focused in on the rate of return of an insurance policy and how they can make a little bit more in something else. And they don't consider and take into account the conservative nature of the insurance, the protection of the insurance, the tax-free growth of the insurance, as long as you don't sell or surrender that policy, and the income that it can produce. And that's a whole nother topic we could get into as to why that is, but it's one of
Yeah.
the reasons why I like insurance as an asset class, period.
Well, and the big one, Kirk, is access to their money, where you can tap into your money and still keep that money working for you.
Yeah,
That's what insurance allows clients to do, and they love that concept. Like just because I took $10,000 out to go help with that, or I took a loan against it, or I accessed it in my investment account, that money is gone. Whereas here, I can access it in a way that keeps the money growing for me at the same time as using it.
yeah.